Welcome back to the Neko podcast, where we discuss all things feline.
Today, we are diving deep into the mystery of the laser pointer.
Make sure to subscribe and leave a review.
If you transported an investor from like 1950 to today, I'm pretty sure they would think the stock market was just completely broken.
Oh, absolutely. It would look completely unrecognizable to them.
Right, because back then, almost 90% of U.S. companies paid you cash, like just for owning them. It was a given.
It was just how investing worked.
Yeah, exactly. But today, that number has plummeted to just 38%.
Yeah, it's a huge drop.
So if the traditional dividend is basically dying out, it begs this really massive question. How are modern investors pulling, 10, 12, even 15% annualized yields out of thin air every single month?
Well, that vanishing act of the traditional dividend, it really completely rewired how people have to plan for their financial future.
Right.
And really, the mission for our deep dive today is to unpack the financial engineering that basically replaced it. Specifically, we're looking at covered call ETFs or, options income ETF.
Which are just everywhere right now.
They really are. So we are going to look under the hood to see exactly how these funds manufacture those double-digit yields and why an investor might pivot to them over traditional dividend stocks.
And I'm guessing we'll talk about the catch. Right?
Oh, definitely. We have to cover the brutal mathematical trade-offs that are just baked into their DNA.
I want to start right there, actually, with that disappearing dividend.
Mm-hmm.
Because looking at the Dimensional Fund Advisors study in our sources, the shift is staggering.
It really is.
I mean, going from 90% of companies paying dividends down to 38%, that isn't just a slight market trend. It feels like a fundamental change in corporate psychology. Why did companies just stop handing out cash?
Well, the shift really came down to tax efficiency and the rise of the modern tech giant.
Okay, how so?
Over the last few decades, corporate boards realized that paying a cash dividend was incredibly inefficient for their shareholders because those shareholders immediately had to pay taxes on that distribution.
Oh, right. The IRS wants their cut right away.
Exactly. So instead, companies started using that excess cash to do stock buybacks, which artificially raises the stock price, but it doesn't trigger a taxable event for you, the shareholder.
That makes sense.
Or, in the case of companies like Amazon or Meta, they just plowed every single cent back into research and development, just fueling this explosive monopolistic growth.
Which is great for growth.
Yeah.
But it leaves anyone relying on the old school income approach completely stranded.
Completely.
Because if you're building a portfolio with this strict rule that you will only live off the interest and dividends, and you absolutely refuse to touch your principal,
you're suddenly totally starved for cash.
Right. You'd be forced into taking on wild risks, like loading up on junk bonds just to hit your basic monthly living expenses.
Yeah, and the alternative to that strict income approach is what we call the total return approach.
Okay, break that down for me.
So a total return investor focuses purely on the overall growth of their portfolio. They really don't care if their cash comes from a quarterly dividend, a bond interest payment, or manually selling off a few shares of an index fund.
They just care about the bottom line.
Exactly. If the portfolio grows by 8% this year and they only need 4% to live on, they just sell the difference.
See, I'm looking at the First Ascent research on this, and it breaks down the math in a way that kind of exposes the income approach as almost a psychological illusion.
It really is an illusion.
Because we cling to dividends because they feel like a bonus. Right. Like the company's just handing us free money while we get to keep our stock. But mechanically, a dividend is identical to forced selling.
Yeah, the accounting is inescapable there. When a company pays a dividend, that cash literally leaves the corporate bank account.
Right.
So the company is now worth less by the exact amount of cash they just distributed.
The scenario they outline in the sources paints it perfectly. Imagine you own one share of a stock and it's trading at exactly $20. And then the company announces a $1 cash dividend. The millisecond that dividend hits your brokerage account, the stock price adjusts downward to $19.
Precisely.
You now hold a $19 stock and a $1 bill. Your total net worth is still exactly $20.
You haven't gained anything extra.
Exactly. You are in the exact same financial position as if you had just logged in and sold $1 worth of that $20 stock yourself.
And taking that mathematical view is really the only way to evaluate portfolios objectively. But behaviorally, human beings absolutely despise seeing their share count go down.
Oh, I hate it. It feels wrong.
Right. Logging into an account and hitting sell feels like failure. It feels like you are cannibalizing your own wealth, even if the math proves you aren't.
So you have this massive clash. We have this desperate psychological need for passive income that doesn't force us to hit the sell button.
Combined with a stock market that refuses to pay traditional dividends anymore.
Right. And Wall Street is rarely slow to monetize a psychological need. Looking at the massive inflow of capital in these research notes, their solution was the covered call ETF.
Yeah. Let's break down the mechanics of what these funds are actually doing, because they operate on a massive industrial scale.
Okay, how does it actually work?
The strategy has two distinct steps. The first is pretty straightforward. The ETF just buys a broad basket of stocks. So if you buy a fund tracking the S&P 500, the ETF goes out and buys the actual underlying shares of those 500 largest U.S. companies.
Okay, so the foundation is just a standard index fund. Nothing really exotic there.
Right. But step two is where that 12% yield materializes.
Yeah, the sources say the fund systematically sells call options against that portfolio.
Right.
For someone who doesn't spend their day staring at a Bloomberg terminal, we kind of need to map this to the real world.
Sure. So a call option is simply a contract. When you sell a call option, you are selling someone else the right but not the obligation to buy your stock at a specific predetermined price on a specific date in the future.
Okay, let me try out an analogy here to see if the mechanics line up. Imagine you own a house, and it's currently valued at $500,000.
Okay, tracking.
And a developer approaches you and says, I think this neighborhood is about to explode in value. I will pay you $5,000 in pure cash, non-refundable, right now, just for the absolute right to buy your house for $520,000 next month.
The structure is identical. You take the $5,000 today, that's your premium, and you get to keep that cash no matter what happens next.
So fast forward a month. If the local housing market stays totally flat or even drops, my house is still worth $500,000.
Right, so the developer isn't going to exercise his right to buy it for $520,000. That would be a bad deal for him.
Exactly. He walks away, I keep my house, I keep his $5,000, and I can turn around and sell that exact same contract to someone else the very next day.
Now just scale that up. A covered call ETF does this with thousands of shares of Apple, Microsoft, Amazon, NVIDIA, all of them. It holds the shares. That's the covered part, meaning they actually own the asset they are writing contracts against. Then they go into the options market and sell the right for hedge funds or speculators to buy those shares at a set price in the future.
And those buyers are paying billions of dollars in cash premiums.
Exactly. The ETF collects that absolute mountain of cash and funnels it directly to you, the shareholder, as a monthly distribution.
And the yield generated by doing this is staggering. Like, the data for global X funds in the sources is wild.
Yeah, the numbers are huge.
QYLD, which writes covered calls on the NASDAQ 100, consistently generates annualized distributions between 11 and 13%. And XYLD, doing the same thing on the S&P 500, pays out 10 to 12%.
And it drops into your account every 30 days.
That's the crazy part. Every single month.
And that monthly cadence is a massive draw for retirees who are just trying to match their income to their monthly expenses. Because, traditional dividends are typically quarterly, which requires all these budgeting gymnastics.
It also kind of democratizes a strategy that used to be locked behind a massive capital wall.
Oh, absolutely.
Because before these ETFs, if I wanted to sell a covered call on a single stock, say NVIDIA, the options market requires contracts to be sold in batches of 100 shares.
Right, a standard contract size.
So if NVIDIA is trading at $100, I need $10,000 in capital just to execute one single covered call trade on one single company. The ETF wrapper does it across the entire index for the cost of like a $50 share.
The convenience factor is undeniable. The ETF handles the complex rolling of contracts, the strike price calculations, the execute, all of it.
But, if I am sitting here staring at a completely passive, hands-off 12% yield that just gets deposited while I sleep,
Yeah.
I have to ask what the structural trap is.
There's always a trap.
Right. Wall Street does not mint 12% yields without taking something of equal or greater value in return. So why wouldn't someone just put their entire retirement into QYLD?
Because of the ironclad law of options income, you are trading your future upside for current cash.
Okay, walk me through that.
Let's go back to your house analogy. You took the $5,000 and you signed a contract agreeing to sell your house for $520,000 next month.
Right. And if the market stays flat, I win.
But what happens if a major tech company announces they are building their new global headquarters right down the street? The neighborhood goes manic, and the market value of your house skyrockets to $700,000 overnight.
Oh, Right. The contract is binding.
Exact.
The developer exercises his right, buys my house for $520,000, and I am basically forced to hand over the keys. I completely miss out on that $180,000 of new explosive growth.
That is the massive invisible cost of a covered call ETF. By systematically selling call options, the fund manager is putting a hard ceiling on the portfolio's growth.
Wow.
So if the Nasdaq goes on a massive bull run and jumps 10% in a single month, the underlying tech stocks inside QYLD went up. But the fund already sold away their rights to those massive gains.
I am looking at the historical data for QYLD between 2021 and 2023, and it illustrates this asymmetry so painfully.
It's a brutal chart to look at.
The Nasdaq 100 is an incredibly volatile index, and in 2022, tech stocks basically crashed. Because QYLD owns those underlying stocks, it took the full force of that crash.
Right, because you hold the asset.
The net asset value, the actual share price of the ETF fell from around $25 down to roughly $16. That is a 34% destruction of principal.
Yeah, the premium collected provides a tiny little shock absorber, but fundamentally you are fully exposed to the downside of the market. If the index drops 30%, your underlying assets drop 30%.
But the real tragedy is the recovery. When the market finally bounced back and went on that massive rally, QYLD couldn't follow it up.
Because of the cap.
Exactly. Because every single month as the market was climbing, the ETF's algorithmic rules forced it to sell calls just above its newly depressed price.
It capped its own upside at the knees month after month.
You took 100% of the pain on the way down, but mathematically engineered yourself out of the recovery on the way up.
And this specific mechanic dictates exactly when these passive funds should be deployed. They are highly situational tools.
So when do you actually use them?
Well, if you deploy them in a roaring extended bull market, they act as an anchor on your wealth. They constantly sacrifice the compounding growth that builds long-term fortunes.
So they only shine if the market goes absolutely nowhere.
Precisely. In a flat, range-bound market, traditional index investors are making 0%. But the covered call investors just sitting there, farming the volatility, collecting their 1% cash premium every single month, while the underlying stocks bounce around uselessly.
Okay, but the financial industry must have recognized this fatal flaw in purely passive strategies, right? Locking in losses during a crash and capping gains during a recovery is structurally unappealing for almost anyone.
Absolutely. So the space evolved toward active management to try and fix that asymmetry.
The sources highlight funds like JBPI from JP Morgan or QQQI, which uses an AI-driven approach. If the problem with QYLD is that it blindly sells calls on 100% of its portfolio at the exact same relative level every month, how does human or algorithmic intervention actually solve that?
It all comes down to dynamic pricing and understanding volatility. Instead of a rigid, robotic rulebook, active managers evaluate the current market environment. They are constantly looking at metrics like the VIX, which measures market volatility.
Often called the fear gauge.
Exactly.
Let's walk through how volatility actually changes the strategy. If the VIX is spiking and the market is panicking, how does a fund like JPI react differently than a passive fund?
So when the market is scared, options premiums become highly inflated. Speculators are willing to pay massive amounts of cash for options contracts.
Because everyone expects crazy price swings.
Right. An active manager recognizes this, and because the premiums are so rich, the manager doesn't need to sell calls on 100% of the portfolio just to hit their yield target. They might only sell calls on 50% of the portfolio.
Meaning the other half of the portfolio is completely uncapped and free to run if the market suddenly rebounds.
Precisely. Or they utilize the inflated premiums to write calls much further out of the money.
Wait, out of the money? We need to translate that back to the house analogy.
Sure.
You mean instead of selling the developer the right to buy my $500,000 house at $520,000, the active manager says, premiums are so high right now, I can still get my $5,000 cash fee by setting the strike price at $700,000.
That is exactly it. Setting the strike price further out of the money means leaving a massive runway for the asset to grow before the cap kicks in.
Okay, that makes sense.
Yeah, human managers or the AI systems running QQQI dynamically adjust those strike prices and the volume of contracts based on how expensive volatility is on any given day.
But there's no free lunch here. If JPI is intentionally writing fewer calls or writing them further away to capture more growth, the raw cash flow has to take a hit.
It does. JPI's yield generally floats around 8 to 9% compared to the 12% you might see from a purely passive strategy.
Okay, so you are sacrificing absolute maximum yield in exchange for principal protection and some actual upside capture in a bull market.
Exactly. It's a trade-off.
I am noticing a detail in the prospectus data that totally flips the usual script, though.
Huh?
We are trained to believe that active management always means getting gouged on fees, but JEPI's expense ratio is 0.35%, while the passive QYLD charges 0.60%.
The sheer scale of JP Morgan allows them to compress fees in a way that just forces the rest of the industry to adapt.
Interesting.
But that fee structure brings up another critical friction point that investors tend to ignore until April.
Taxes.
The tax treatment of these massive distributions.
This is exactly what I was trying to figure out. If I am pulling down a 10% yield in a regular taxable brokerage account, my immediate thought is that the IRS is going to absolutely slaughter me.
Naturally.
I mean, ordinary income tax brackets can run up to 37%. Are these distributions taxed like a regular bond interest payment? Or is there a loophole hiding in the options mechanics?
It is actually entirely different from bond interest, owing to a very specific tax code classification. Broad index options, the instruments these funds use to generate their premiums, they are generally treated as Section 1256 contracts by the IRS.
Section 1256. Walk me through the actual mechanics of what that means for the tax bill.
So Section 1256 contracts are governed by the 60/40 rule.
Okay.
When the ETF distributes the options premium to you, the IRS dictates that 60% of that income is taxed at the long-term capital gains rate, and 40% is taxed at the short-term capital gains rate.
Wait, really?
Yeah, and this applies regardless of how long you or the fund actually held the contract.
Okay, that is a massive structural advantage. Long-term capital gains rates max out at 20%, compared to 37% for ordinary income.
Exactly.
Getting 60% of your massive yield pushed into that much lower tax bracket makes a tangible difference to the actual cash you get to spend. But why does the IRS offer such a generous carve-out just for index options?
Well, the 60/40 rule was historically designed to ensure liquidity in the broad financial markets. Market makers execute millions of microtransactions a day in these index options.
Right, it's a high-frequency game.
If they had to track the exact holding period of every single fraction of a second trade for tax purposes, the accounting would literally paralyze the system.
That makes sense.
So the IRS created a blanket 60/40 rule to simplify reporting and incentivize high-volume trading, which keeps the overall market functioning smoothly. The ETF investor simply inherits the benefit of that systemic rule.
It's a structural grease for the wheels of the market.
Yeah.
But, there's another metric issue in these sources that feels like a trap for anyone screening for funds on their brokerage app.
Oh, the yield trap.
Yeah. If I look up a standard bond fund, I just check the 30-day SEC yield to see my expected payout. But the sources note that if you look up the 30-day SEC yield for a covered call ETF, it might display this really anemic number, like 1 or 2%.
Right. And that's because the 30-day SEC yield is a rigid, standardized calculation. It was created decades ago to allow apples-to-apples comparisons between regular mutual funds.
Right.
By law, it only calculates traditional interest payments and traditional dividends generated by the underlying portfolio over the last 30 days.
Oh, I see the problem. It completely ignores the options contracts.
Entirely. Because selling a covered call is technically a capital transaction, not a dividend or interest payment, the SEC formula blinds itself to the actual engine of the ETF.
It only measures the tiny dividends paid by the tech stocks in the portfolio, missing the massive options premium entirely.
Exactly. So if a listener is trying to evaluate these, looking at the SEC yield will literally make the fund look broken.
So to see the true cash flow, the sources indicate you have to look at the distribution rate or distribution yield,
Right.
which annualizes the most recent total payout, including all the options cash.
Right. The distribution rate is the actual reflection of the cash hitting your account.
So putting all the pieces of this puzzle together, the death of the traditional dividend basically forced the creation of the options income ETF.
It was inevitable.
And they are incredible feats of financial engineering that can systematically harvest 8 to 15% yields by selling the future upside of their portfolios. They are spectacularly efficient in flat markets.
Very true.
But the absolute cost of that massive monthly cash deposit is capping your long-term compounding growth during a bull market.
Which is why the introduction of dynamic active management in funds like JPI has become the new baseline for investors who are trying to balance high current income with principal preservation.
But stepping back from the individual portfolio for a second, The sheer scale of this transition leaves us with a totally different kind of question to explore. I mean, millions of baby boomers are reaching retirement, starving for yield, and pouring hundreds of billions of dollars into these algorithmic covered call strategies.
The capital inflow over the last 5 years has been historic, unprecedented, really.
If a massive growing percentage of the total market is now systematically selling call options against the S&P 500 and the NASDAQ every single month, it means an enormous amount of the market's future upside is constantly being capped and sold off.
That's the macro picture. Yeah.
Imagine the macroeconomic effect of that. If trillions of dollars are essentially suppressing the upper limits of the stock market to manufacture monthly yield, does this algorithmic gravity eventually compress the volatility of the entire global market?
It's a huge question.
Do these income funds become so massive that they actually alter the ceiling of the indices they track?
Honestly, it is the defining structural question for the next decade of market mechanics. Because when the tools designed to harvest volatility become larger than the volatility itself, the nature of the market fundamentally changes.
That's a fascinating thought experiment. Keep questioning the mechanics behind the yield, always check your distribution rates, and thanks for joining us on this deep dive.